This week at the zoo, the U.S. blacklists Chinese companies in another round of U.S.-China trade wars. More companies file for bankruptcy, and is there finally a vaccine that doesn't include taking an anti-malaria drug? Hint, no, not really. Hello and welcome back to the Wall Street Petting Zoo. This is our This Week at the Zoo segment in which we reflect on the last week's news and look ahead to the coming week. I'm Christopher Smith, and I'm doing the podcast solo this week because Robert has a 24-hour Twitch stream coming up and needs some well-earned beauty rest so that he is not just gonna crash in the middle of the thing. On Monday, the stock market was up on news that Moderna reported positive phase 1 results for a potential coronavirus vaccine. These results turned out the following day to be not as good as expected, so Moderna surged on Monday and then sold off the next couple days. With the possibility of a vaccine and states easing shelter-in-place orders, airline and cruise liner stocks jumped on the news, and we also saw a surge in oil prices that helped lift markets on Monday as well. Tuesday, the market pulled back slightly as investors reevaluated those Moderna results. In the retail sector, Walmart and Home Depot posted better than expected sales numbers, and Pier 1 entered bankruptcy proceedings. So this highlights the strong divide in retail between the winners, the grocery stores and sort of variety stores, and the losers, such as specialty retail stores. The Federal Housing Finance Agency on Tuesday also loosened some regulations, making it easier to refinance a mortgage that's in forbearance, which is good news for homeowners and probably good news for the real estate market. Airlines on Tuesday announced that they're starting to see some recovery in demand for flights, although it's still far below pre-pandemic levels in terms of demand. Wednesday, the market moved strongly higher on news of promising animal trial results for the Inovio Pharmaceuticals vaccine. We also got our second week in a row of surprise reduction in crude oil inventories, which suggests that supply remains weak and demand is returning faster than expected in the oil market. The U.S. also imposed new sanctions on Iran, which may further strengthen oil prices. And in earnings, cruise liner Royal Caribbean posted a wider than expected loss, while retail chains Target and Lowe's reported earnings well above the Wall Street consensus estimate. So again, essential retail chains are outperforming, while there continues to be underperformance by travel companies like Royal Caribbean. Thursday, more jobless claims came in line with analyst estimates, about 2.4 million, bringing the total to 38.6 million in just 9 weeks, which is a huge surge in unemployment. Many of those will be temporary job losses, but we're still looking at, probably a quarter of those or more will be permanent job losses. So pretty significant hit to the economy, and we probably will see that manifest as weakened demand over the next couple of years. Manufacturing numbers came in a little better than expected, but home sales for April came in a couple percent worse than expected, in the 17% range rather than the 15% range, as analysts expected. Minus 17% rather than minus 15%. Data for April also indicated that about 15 million Americans skipped their credit card payments, and 3 million skipped their car payments in April under deferral programs, financial hardship payment deferral programs. And we also saw a surge of 1.6 million in home loan delinquencies, which is the largest increase ever in home loan delinquencies. So things aren't looking great for lenders in the financial sector right now. There was pain for retail too, as Victoria's Secret announced that it will permanently close a quarter of its stores. And shippers saw a hit as the World Trade Organization's barometer of world trade showed a steep decline, which is bad for shippers. So overall, some pretty bad economic data out there. But markets surprisingly only dipped slightly on all of this bad economic news. On Friday, the U.S. Senate passed a bill that would make it more difficult for Chinese companies to list on U.S. stock exchanges. And immediately, the Chinese companies like Baidu and Baba started talking about delisting from U.S. stock exchanges on their own rights. So it's kind of the breakup situation where it's like, I'm breaking up with you. No, I'm breaking up with you. But anyway, it looks like those Chinese companies will exit U.S. stock exchanges. Furthermore, China also declined to provide an annual GDP target for their economic growth for the first time in almost 30 years. So lots of bad news in relation to China stocks. And as a result, despite a big earnings beat from Alibaba, which is the Chinese Amazon, Alibaba sold off along with other China stocks on U.S. stock exchanges, including Baidu. Hong Kong and Taiwan stocks also tanked on Friday as the Chinese moved to classify anti-government protests of the sort that we saw in Hong Kong last year as treason and terrorism in one of its most blatant anti-democratic moves in the last sort of 10 years. Despite the rising tensions between the U.S. and China, U.S. stocks posted a small gain going into the 3-day weekend. Stocks we watched last week. So last week we predicted a short squeeze in oil, which we did see this week. We started the week off with like an 8% gain in oil on Monday. So really big moves in oil ahead of the futures contract expiration. There were a lot of traders who were expecting oil to sell off and potentially go negative this month as it did last month ahead of the futures expiration date. But I was predicting that those shorts would be disappointed and that they would get squeezed out of the market on Monday and Tuesday, and we would see a big surge in oil. And that's exactly what happened this week. On Monday and Tuesday, we saw a pretty significant surge in oil prices. I also predicted that silver would continue to climb this week. Silver did climb 3.5% this week. I predicted an earnings beat from Baidu, the Chinese company Baidu, but I also suggested that it would probably come crashing back down to earth after, an initial surge on those earnings results due to U.S.-China trade tensions. And that is exactly what happened this week. Baidu posted about double the earnings the analysts expected. Really, really strong results. And it did soar on that news, but then it did come crashing back down due to those U.S.-China tensions. And Robert predicted last week strong sales numbers from Walmart and Target, and both of those companies delivered on that, although both of them sold off after their strong earnings numbers as part of sort of general market pessimism about the retail sector. So really, we were right about a lot of what we predicted last week. This week, Robert is watching Disney. He notes that Universal Studios has announced that they will be opening their parks in limited capacity on June 5th, which is a good sign for Disney as they look to open up on July 1st. Also, with talks of NHL season returning and the NBA in talks to complete their season, this can only help ESPN, which is owned by Disney. And so Robert thinks that this presents a buying opportunity for Disney, although he warns that any negative news on rising coronavirus cases or potential vaccine failures will obviously have a negative impact on Disney's business and stock price. And keep in mind, we are seeing rising coronavirus cases. In fact, we're nearly back to the replacement level at a national level. We have been below replacement level, which means that the number of active coronavirus cases was actually decreasing. But we're almost back to replacement level, so we could potentially see a new sort of surge in coronavirus cases as economies reopen. So beware of that. Personally, I still think that valuations are much too high at this level. We're at 23 forward PE, pretty high valuations historically speaking. With COVID-19 cases rising again, I think that we may be on the verge of another sell-off. So personally, I am just sort of watching and waiting right now. I am looking for buying opportunities on Applied Materials and Intel. I think that the semiconductor sector has been really hot, and it tends to pretty consistently outperform the rest of the market. And Applied Materials and Intel are two of the only semiconductor companies out there that still have good valuations at current prices. So those are two that I am watching for entries at this level. Folks, if you heard something on the podcast this week that was helpful to you, please give us a like, share, or comment on YouTube. You can also follow us on Podbean and iTunes, where we post the audio for our podcast. Underneath the YouTube video, we also have a link to Webull. You can use our referral link to open up a new Webull account, and if you deposit $100 in your account, then you'll get a couple free stocks, and so will we. That helps us support the podcast. We would really, really appreciate your support. And also, just tell your friends about the podcast if you find it useful. We would love to have your support in helping us get the word out there, because we don't do any paid marketing or advertising for this. It's all word of mouth, and so that's really the only way that we have to get the word out there and accumulate more listeners. So we really appreciate any support that you can give us in that regard. And that's all, folks. We will see you next week at the zoo.